Today, we're doing something a little different. We're cracking open a 2011 annual letter from Giverny Capital, penned by its founder, Francois Rochon. It's a fascinating glimpse into how a top investment firm navigated a really tough year,
Yeah.
sharing not just their wins, but their misses, and some timeless lessons, too.
That's right. So our mission for you today is to really unpack Giverny Capital's approach during that turbulent 2011. We'll dive deep into their enduring investment philosophy, dissect their actual portfolio decisions, the successes,
The big ones.
and even their self-admitted, publicly documented errors.
Yeah.
You'll discover why their insights from, well, over a decade ago now still offer incredibly valuable lessons for anyone navigating the markets today.
Definitely. And to give you the clearest picture, our deep dive is based entirely on that 2011 annual letter to partners from Giverny Capital Inc. We've pulled from its detailed performance tables, the specific company updates, and that truly revealing podium of errors section.
Oh, yeah, that's a highlight.
It really is.
Yeah.
We'll also draw insights from the intriguing artwork featured on the letter itself, Pierre Dorian's Gate 2, 22nd Street, and other company visuals, like the Bank of the Ozarks stock chart and photos of those key CEOs and investing legends mentioned throughout.
Great. So let's set the stage. 2011 was, to put it mildly, a turbulent year globally. The European financial crisis cast a long shadow, sending ripples across stock markets worldwide.
You really did.
Most major markets outside the U.S. finished the year deep in the red.
You know, when we think of 2011, it's easy to forget just how widespread that turbulence was. Even places like China, right, often seen as an economic powerhouse, saw their Shanghai market drop nearly 20% that year alone.
Wow.
And if you zoom out, that was a staggering 64% decline from its 2007 peak. Just huge.
Yeah.
And closer to home, Canada's TSX saw an 8.7% loss, significantly underperforming the S&P 500.
Right.
It truly was a tough environment for many.
Absolutely. Yet despite this widespread global slump, Giverny Capital described 2011 as a grand cru year for their portfolio companies.
Grand Cru, like a fine wine.
Exactly. Think of it like a vintage wine or a truly exceptional year. This means their businesses, by and large, had outstanding financial results and notably resisted the general market decline.
That's a huge claim for such a difficult year. What do the numbers say about their actual performance? How did they manage that?
Well, their numbers really bear that out, and it's quite striking. Their global portfolio returned a remarkable 7.8% in 2011.
Okay.
Now, compare that to its benchmark, which actually lost 1.1%.
Well,
That's an outperformance of 8.9%, almost 9%.
incredible.
And if you look at their long-term track record, since inception back in 93, they've compounded annually at 13.6% versus just 6.6% for their benchmark. That's a consistent 6.9% annual outperformance.
That's serious consistency.
Yeah, or even 15% versus 7.9% when you exclude currency effects. It's impressive.
And I think they mentioned an ambitious objective, right, to maintain an annual return 5% higher than their benchmark long-term.
That's their stated goal, yeah. And it played out across their specific portfolios, too, even with that tough global backdrop. In 2011, their U.S. portfolio returned 5.0% compared to the S&P 500's 2.1%.
Still beating the market.
Right. And since 93 inception, that U.S. portfolio returned 14.1% annualized versus 7.8% for the S&P 500. So adding, a consistent 6.4% annually.
A Canada portfolio, that one really stood out, launched in 2007, right?
Yeah, relatively new then, but it returned 13.5% in 2011.
Against the S&P TSX, loss of 8.7%.
Exactly. Outperforming by a stunning 22.2%.
22%.
Since 2007, it's returned 10.7% annualized versus just 1.0% for the S&P TSX. So that's an annual added value of 9.7%. Just phenomenal.
This performance, especially in such a challenging year, isn't just numbers on a page, is it?
Not at all. It powerfully demonstrates that even when market conditions are, frankly, dire, a disciplined, distinct investment approach, one that focuses on underlying business fundamentals, it can still yield superior capital-preserving results. It's a testament to sticking to your principles when, everyone else is panicking.
Speaking of panic, the Giverny letter really challenged some of the conventional wisdom of 2011. They pointed out what they called a near obsession with Western government debt problems.
Among the media, and interestingly, what they termed savers rather than true investors.
Yeah, that distinction is key. What did that obsession lead to in the market according to them?
Well, it created this striking valuation disparity. You had corporations, for the most part, managing finances rationally,
Okay.
yet their stocks, corporate securities, were being shunned. People were flocking instead to governmental debt securities, treasuries.
So selling businesses to buy government debt.
Pretty much. Consider this. In 2011, the S&P 500 traded at 12 times its earning power. That's like an 8% earnings yield.
Okay, decent yield.
Meanwhile, 10-year treasury notes, they traded at 50 times their interest payment for, a measly 2% yield.
50 times for a 2% yield versus 12 times for an 8% yield. That's a huge disconnect.
Exactly. The letter provocatively calls it a guarantee of impoverishment.
Wow. That's strong language.
It is. It sounds like people were literally selling ownership in good businesses to buy something that, after inflation, guaranteed they'd lose money.
So the irony was, people worried about government debt were buying more government debt.
Precisely. They were selling equity funds to buy treasury funds, often while simultaneously, ranting against government debt, but they were buying more of it at rates that practically guaranteed a loss of purchasing power. A 10-year note yielding 2% with maybe 3% inflation, you're losing money in real terms.
It was a fascinating and kind of tragic paradox.
Yeah.
So if everyone else was so pessimistic, what did Giverny Capital do? Did they just, sit tight? Or did they see an opportunity?
Oh, they absolutely capitalized on it. This widespread pessimism, especially in August and September of 2011 when the market looked like it was heading for a bear market, it created what Giverny called many bargains.
Bargains. Okay.
Despite their typical average holding period of 5 years, they became quite active. They increased holdings in already undervalued existing positions, sort of selling things trading at maybe 60% of intrinsic value to buy others trading at 40%,
Trading up on the discount, essentially.
Exactly.
Yeah.
And they purchased some new positions, too.
This isn't just Giverny's story, is it? It's a powerful lesson in contrarian thinking for all of us.
Absolutely.
When everyone else is running for the exits, that's often when true value emerges for the disciplined investor.
If you have the conviction.
Right. It's about having that conviction to look for opportunities when fear is, peaking.
And that conviction is deeply rooted in Giverny's timeless investment philosophy. For any new partners and, for us looking at this letter, they reiterate their core beliefs. Stocks are the best long-term investment class.
Okay.
And predicting market timing. Absolutely futile. Forget about it.
Their philosophy seems very clear about the why behind their investments. How do they actually go about identifying these companies they want to own? What's the process?
It's all about intrinsic value. That's the core. They believe a stock's return will eventually mirror the increase in the underlying company's intrinsic value, often linked directly to its return on equity.
Makes sense.
So they meticulously seek out companies with high and sustainable margins, high returns on equity, strong long-term prospects, and crucially, this is key for them, brilliant, honest, and dedicated management.
Management matters a lot.
Immensely. Once they choose a company that ticks those boxes, they then assess its approximate intrinsic value.
And for them, market volatility isn't something to fear. It sounds like it's almost an ally.
Exactly. They see the market as often dominated by participants who treat stocks like casino chips. Pure speculation.
Right.
This irrationality, they argue, is actually an advantage for the intelligent investor. It allows them to buy great businesses well below their intrinsic values.
They quote Benjamin Graham, right?
They do. Graham said the market's irrationality is an extraordinary advantage to the intelligent investor. Short-term fluctuations, anything less than 5 years, they say, become an enemy only if your decisions are based on them.
So patience is key.
Patience is the keystone for success, as they put it, from both the firm and its partners. This long-term view lets them weather the short-term noise. And each year, Giverny also identifies what they call the flavor of the day.
I love that concept, flavor of the day. What's that about?
It's basically what's popular, what everyone's chasing, but likely to yield little financial reward in the long run.
Okay, so what were some of these flavors they'd identified before 2011?
In previous years, they'd called out things like bonds, Canadian real estate, and gold as these flavors.
Things people get excited about.
Exactly. For 2011, the flavor of the day was essentially to detest stocks and the markets.
The pessimism itself.
Yeah, exemplified by movements like Occupy Wall Street. And for Giverny, this widespread negativity actually amplified their enthusiasm for stocks. It reinforced their belief in compelling market valuations. They basically saw the prevailing pessimism as a buy signal.
Fascinating. So instead of looking at daily stock prices, Giverny focuses on what Warren Buffett calls owner's earnings. Can you break that down?
Sure. They define owner's earnings simply as EPS growth plus the average dividend yield. It's a measure of the underlying business's return to the owner.
Okay. How did their portfolio companies fare by that measure in 2011?
Well, according to their calculations, in 2011, their company's intrinsic value rose by 17%.
17% growth in value.
Right. 16% from earnings growth, 1% from dividends, yet their stocks only rose 6%, excluding currency effects.
So the value went up way more than the price.
Precisely, which meant their companies were more undervalued at the end of the year than at the start. A powerful insight.
And did the broader market show something similar?
It did. The S&P 500 saw a similar phenomenon. Underlying earnings growth was also around 17%, but the index itself only rose 2%.
So the market just wasn't reflecting the underlying business performance at all that year. Does that synchronization eventually happen?
Well, this illustrates a critical point they make. Market performance and corporate performance are rarely synchronized in the short term.
Right.
But, and this is the key quote, as more time passes, the synchronization between the two begins to reveal itself.
Ah, the long game.
Exactly. Giverny's consistent 5% outperformance over the long haul wasn't magic. It was simply because their company's intrinsic value grew, on average, 5% faster than the S&P 500 companies.
It's a profound lesson in patience and letting the fundamentals, well, do the work over time.
It really is.
And in 2011, Francois Rochon even made a rare public prediction. Published in the Montreal Gazette in August, right? What was that?
Yeah, pretty bold. He predicted the Dow Jones Industrial Average would rise to 17,000 within 5 years, so by 2016.
Wow. What was that based on? Gut feeling.
Not at all. Very logical, actually. It was based on a projected 6.5% annual corporate earnings growth and assuming a PE multiple of 15. Simple math.
Okay.
Including dividends, that translated to more than a 10% expected annual return. He planned to revisit it in the 2016 letter, which is, showing accountability.
Absolutely.
And he even connects this back to his hero, Benjamin Graham. Graham gave a speech in 1974 predicting the future of equities would be roughly the same as their past. Graham pointed out back then that a $10,000 investment in the Dow in 1974 would likely be worth over $500,000 by, well, around now.
It turned out to be right, didn't it?
Pretty much spot on. It demonstrated an 11% annual return, proving his mentor correct.
Oh.
It shows the power of that long-term perspective.
That's a great example of sticking to a long-term vision. This really highlights for us, the listeners, that evaluating investments isn't just about daily stock prices. It's about understanding the underlying business and its intrinsic value. It's not about the flash, it's about the fundamentals.
Exactly. And those fundamentals are what we see when we look at their portfolio in detail, particularly in their annual 5-year post-mortem review. They mentioned 2006 was a difficult year for them, their worst year relative to market indices, they called it.
Right. So what was their reaction to that tough period? Did they change strategy?
Nope. Their reaction was simple: remain loyal to their philosophy. As they wrote, if we are on right path, the only thing left to do is to keep walking.
Stick with it.
Exactly. Many of their portfolio companies actually saw stock price declines in 2006 despite increasing earnings per share. Fastenal, for example, its stock dropped 8% even with 21% EPS growth back then. But it has since doubled.
Shows the disconnect again.
Right. And over the 5 years since that tough 2006, their holdings returned 5.1% annually versus an annual loss of 0.4% for the indices, excluding currency. So patience paid off.
And they also highlighted the flavor of the day from 2006, didn't they? What was that?
Canadian banks, remember those? They were climbing 15% annually, totally beloved by investors. PE multiples expanding rapidly from like 8x to 14x.
Everyone loved them.
Everyone. But Rochon felt it was unrealistic for them to do much better than the, maybe 5% growth of the broader Canadian economy.
And what happened?
Well, over the next 5 years, Bank of Montreal dropped from $69 to $56, and Scotiabank basically stayed flat, $52 to $51.
Ouch. So buying the popular trend didn't work out there?
A great example of how that can lead to underperformance.
Let's talk about some specific investments from that 2006 period. They candidly discuss Mohawk Industries as a misstep. What was the story there?
Yeah, Mohawk Industries. It's the largest floor covering company in the U.S. Giverny bought it at $75 in 2006, but by 2011, it was trading down at $64.
Like, why?
It was just heavily affected by the massive depression in U.S. residential construction post-2006. Its EPS dropped significantly before starting to rebound. But despite the poor stock performance, Giverny still admired the management and anticipated a rebound. It shows their conviction in the underlying business, even when the market price wasn't reflecting it.
Okay, so that was the tough one. What about the flip side?
Mhm.
A true success story from that same period?
A true success was Bank of the Ozarks. Now, that was a rewarding investment. It doubled in the 5 years since their late 2006 purchase.
Doubled. Nice.
George Gleason, the CEO, took control back in 1979 when assets were just $28 million. He grew them to over $3.8 billion.
Wow, that's incredible growth.
The company went public in 1997 at $2 a share, split adjusted, and by 2011, the stock had increased 15-fold, an annualized return of 21%.
15-fold. So a bank that grew like that, you might think they were doing something really aggressive, right? Subprime derivatives.
Exactly what you might think, but no. The letter emphasizes their conservative approach. They conduct, and I quote, nothing exotic or esoteric, no subprime mortgages, no incomprehensible derivative products, only traditional banking activity.
Just basic banking done well.
Precisely. Their conservatism allowed them not only to survive the 2008-2009 crisis, but actually to make excellent FDIC-aided acquisitions at bargain prices. They increased assets by 50% during the crisis.
Buying when others were forced sellers.
Right. This example really challenges the stereotype that risk and reward don't necessarily always go hand in hand. Sometimes boring is beautiful.
And profitable.
And very profitable. Vershawn even recounts the stock dropping 50% 2 years after they bought it. Imagine that. But he advised partners that the fundamentals were intact and not to be affected by short-term fluctuations. That's real conviction in action.
Let's turn our attention to 2011 specifically and highlight a few portfolio standouts mentioned in the letter. American Express, for example.
Right, AXP. They had an excellent year business-wise. Revenues up 9%, EPS up 22%, bad loan write-offs declining. Things looked good.
But the stock?
Well, despite profits being 21% higher than pre-crisis 2007, the stock was actually down from 65 to 47x, and its PE tumbled from 19x to 11x.
So another disconnect. Why did Giverny like it?
They argued the financial crisis actually allowed Amex to become a bank and gain market share, proving its integrated business model was intact, maybe even stronger. They considered it one of the strongest brands, definitely undervalued at 11 times earnings. It really shows their philosophy. Looking past the price to the business strength and strategic position.
Then there's Fastenal. You mentioned him earlier. Giverny's most rewarding investment since 1998. Selling nuts and bolts, right? Sounds boring.
They describe it as having a most boring primary business activity, yes. But don't let that fool you. Its unrivaled profitability comes from a unique culture, decentralized model, and a management team totally dedicated to long-term value creation.
The results speak for themselves.
Absolutely. In 2011 alone, revenues rose 22%, EPS climbed 34%, and they opened 122 new stores, bringing their total to over 2,500. It's a classic example of finding an exceptional business in a, overlooked sector.
Dollarama too, right? The Canadian dollar store chain.
Yeah, DOL on the TSX. Giverny admired its IPO 2 years prior, seeing founder-CEO Larry Rossi as one of the best businessmen in Canada. High praise.
And the stock had done well for them already.
It had already doubled since their purchase. In the first 3 quarters of 2011, revenues were up 12%, same-store sales up 4.4%, and EPS surged 46%. Another example of backing strong management and a good model early on.
Okay, one more. O'Reilly Automotive. Or our lead.
Right. They continued to benefit from what Giverny called a courageous acquisition of almost 1,500 CSK stores during the 2007-08 pessimism. A big bet.
How did that pay off?
Massively. Their number of stores more than doubled, sales soared, EPS climbed significantly. Since Giverny's initial 2004 purchase, O'Reilly's earnings grew 350%. That's 20% annually compounded, and the stock quadrupled.
Wow. So it really highlights the power of making those bulls contrarian moves during market downturns, if you have the right target.
Exactly. Conviction again.
Beyond their existing holdings, Giverny made some interesting new investments in 2011. Google, for instance. They're usually wary of tech, right?
They are. They say they're generally not fond of technology companies because of rapid obsolescence. It's a fair point.
So how did Google fit in?
Well, they argued Google wasn't really a tech company in the traditional hardware sense, but more a service provider with a truly dominant brand. I mean, to Google is a verb, right?
Yeah.
They bought during a market correction, attracted by how entrenched it was, its resistance to fads. It shows that even in sectors they're generally wary of, they can find exceptions that fit their core criteria.
Makes sense. Another new one was Valent Pharmaceuticals, VRX.
Yeah, that was interesting. They'd followed pharma for years, but felt the traditional model of constant R&D discovery was kind of faltering.
Okay, so what was different about Valent?
Michael Pearson, the CEO, a former McKinsey consultant, he proposed a new model focused on smart acquisitions and resource optimization rather than just pure discovery.
A different strategy. Did it work?
Seemed to. Since Pearson took over in 2008, revenue soared from $872 million to over $2.5 billion by 2011, and operating margins jumped from 19% to 35%.
Impressive numbers.
Giverny doubled its position during a stock correction later that year, believing it was still undervalued at 12 times estimated 2012 earnings. It was a bet on a specific management team and a new, potentially disruptive strategy.
And finally, there's IBM, Big Blue. Roshan mentioned a past missed opportunity with them.
He did. A bit of self-reflection there. Back in 1995, he'd written an article about IBM's unnoticed turnaround. The stock was trading at $20, only 8 times earnings.
So he saw it early.
He saw it, but apparently only bought shares briefly for one partner. He kicked himself later, of course.
We've all been there.
Absolutely. He continued to follow the company as its EPS grew, accelerating to 17% annual growth in the 5 years leading up to 2011. Giverny finally bought shares in 2011, finding IBM better managed under Palmisano then, and its market valuation compelling again. PE of 12x, lowest since 95-96, and the 08-09 crisis lows.
So it's a great illustration of the importance of continuous follow-up, right? And that even the best investors can sometimes miss opportunities the first time around.
Or need to wait for the right price and setup.
Exactly. This whole section gives us really concrete examples of Giverny's philosophy in action. It shows how they apply their principles to real companies navigating, human judgment and market volatility. It's not just theory, it's actual application.
For sure. Now, perhaps the most unique and I would argue the most valuable section of the Letter for Learning is the podium of errors.
Yes, I love this part.
Giverny Capital systematically reviews its decisions to learn from both achievements and errors. It's incredibly important. And they highlight a crucial point. Errors from omission, non-purchases, are often more costly than errors from commission purchases.
That's a powerful statement. Missing out can hurt more than buying something that doesn't work out perfectly. And their candid confessions here are so valuable. Let's start with the bronze medal, Hansen Natural.
Hansen Natural, now known as Monster Beverage, right? Monster.
Yeah, Monster energy drinks. What was the mistake here?
Well, around 2006, a friend enthusiastically recommended Hansen Natural. Giverny's team apparently tried the drink, found the taste strange, and couldn't really see the appeal.
Huh? Didn't like the taste.
Didn't like the taste, but they kept studying it. Then, in 2008, the stock plummeted from $34 down to $11. Big drop. Despite knowing a distribution deal with Anheuser-Busch would likely be very beneficial, Giverny passed. They didn't buy.
And then?
By 2011, the company was twice as profitable, and the stock reached $50. About 4 times the price they considered buying it at.
Ouch.
Roshan joked he should have drank more of their product to stay awake. It's a funny but pointed reminder that sometimes personal preferences or biases can cloud investment judgment.
Definitely. Okay, what about this silver medal winner, Healthcare Services Group, HCSG? How did they miss that one?
Yeah, this one's interesting. They discovered it way back in 1994. It provided cleaning services for healthcare facilities, a classic boring business, ignored by Wall Street.
Sounds like their kind of company, usually.
You'd think so. It had potential, but back then its margins were low and weakening, so Giverny kind of lost interest, put it aside.
Okay.
Years later, they noticed the company's progress. Margins started to improve significantly from 2001 onwards. EPS increased 5-fold over 10 years, and it started paying a dividend in 2003. Increasing it every single year. By 2011, it was paying out basically all its earnings as dividends.
Wow, quite a transformation.
Huge transformation. Revenues grew significantly, and the stock soared from a $1.40 to $19. That's a 1,200% increase.
Almost 100%.
The error, they admitted, was simply to stop following this company. They could have tripled their investment in 6 years, plus pocketed an average 3% dividend yield.
It's a great lesson, right? Don't dismiss boring businesses, and maybe more importantly, keep following companies even if you initially pass. Things change.
Absolutely. Continuous learning, continuous monitoring.
And the gold medal for errors goes to restaurant companies in 2008. This sounds like a classic case of analysis paralysis, maybe. Knowing something was a good idea, but not acting decisively.
It absolutely reads that way. In early 2008, consumer spending sectors were hammered, creating attractive prices for restaurant stocks. Makes sense. Rochon identified Cheesecake Factory, Buffalo Wild Wings, and Panera Bread. He stated their concepts were working well, they had expansion potential. He saw the opportunity.
Okay, so he liked them. What happened with the stocks?
From February 2008 to December 2011, that crisis period and recovery, those three stocks averaged a phenomenal 161% gain.
161%. While the S&P 500...
Decreased 7% over the same period.
Oof. So did Giverny load up.
Despite this clear insight, Giverny only slightly benefited. They bought a modest sum of Buffalo Wild Wings in 2009, but that was about it. Rochon candidly admitted, quote, "I remained seated in the bleachers and didn't act on my enthusiasm."
Wow. Just didn't pull the trigger.
Didn't pull the trigger effectively. It's a powerful lesson in investor psychology and the very real, very high cost of inaction, even when your analysis is right.
These confessions are just incredible. They offer such powerful lessons about psychology, the cost of inaction, like you said, and the importance of continuously following companies, even the boring ones. It's a potent reminder that even the best make mistakes, and, learning from them is absolutely paramount.
Couldn't agree more. Humility is key. And to kind of tie things together near the end of the letter, Rochon shared a personal highlight, meeting his childhood hero, Peter Lynch, in Boston in February 2011.
Peter Lynch, wow.
Yeah. He'd been inspired by Lynch's One Up on Wall Street back in 1992, which then led him to discover Warren Buffett, a common path for many value investors.
Definitely, Lynch is a legend.
And apparently, Lynch still manages portfolios with enthusiasm, which just shows that passion for investing can really endure.
That's great to hear. And speaking of Warren Buffett, the 2008-09 crisis was huge for him, right? Allowed him to make billions in sound investments for Berkshire Hathaway.
Absolutely, deploying capital when others couldn't.
But even then, the market wasn't fully reflecting Berkshire's intrinsic value growth. What happened in 2011 that really highlighted Buffett's own conviction in his company?
Well, when Berkshire's stock price dipped near $70 in September 2011, Giverny actually increased its own position by 50%. They considered it, quote, "one of the best occasions to have bought this stock in our lifetime." High conviction from them.
Okay. But what about Buffett himself?
Right. Crucially, Buffett then announced Berkshire Hathaway would start buying back its own shares. This was the first time since he became president way back in 1965.
First time ever. Wow.
Why? His reasoning was simple and direct. The stock seems undervalued.
Doesn't get much clearer than that.
Not really. It was a profound statement of conviction from arguably the world's greatest investor, sending a clear signal about the true value he saw. Giverny expected the move to be very rewarding.
So reading this letter, Giverny Capital's confidence going forward from 2011 was clearly high, despite the market turmoil.
It really was.
How did their rigorous investment selection process help them navigate those turbulent years? And what was their final outlook?
Well, they felt that their rigorous process allowed them to navigate both the 2008-09 crisis and the 2011 correction effectively. They believed their portfolio companies had the strong balance sheets, and importantly, the management teams needed to not only survive, but to actually increase market share and competitiveness during those difficult times.
Coming out stronger.
Exactly. So the outlook for their companies, they felt, was excellent. And they believed it was an opportune time to invest for anyone, for their partners with excess capital.
It just reinforces how conviction, backed by solid research, even during intense market skepticism, can really lead to those strong long-term gains.
That's the core message, I think.
So maybe a final thought for you, our listeners. What if the biggest risk in investing isn't really the market's inherent volatility? What if it's our own perception of it? And maybe our willingness, or lack thereof, to learn from our missteps, even the public ones like Giverny shares here.
That's a great point.
The Giverny Capital Letter from 2011 isn't just some historical document. It really feels like a timeless guide to disciplined, conviction-based investing.
Absolutely. The principles hold up.
So the question for you is, what flavor of the day are you seeing in the market today that might, just might, in hindsight, be the next great opportunity everyone else is overlooking, something to chew on?